Is inflation back? This is the question that everybody's asking around the world, whether you're a trader or an investor. And with the Nasdaq falling for 3 days straight and yields absolutely skyrocketing, if we break some key points, we're in for some capitulation. Hello, ladies and gentlemen, and welcome back to the Daily Show. We discuss stocks, commodities, and cryptos together. Today, we'll be deep diving into the S&P 500's fall. It got to the level we discussed in the last video, but now will we bounce? The 20 moving average might hold the key. Also, the biggest stock in the world, it fell big time, and it happened right where we discussed it in the last video. But more importantly, I think we need to talk about yields, because this and oil is what everybody's talking about. Well, welcome back everyone to the Daily Show. We discuss the macro, lead indicators, and of course the hottest charts for everything that you've been watching on the charts recently. If you like anything to do with markets, make sure to subscribe because we'll be covering it every day like we always do. Let's begin with a bit of a cross-section of what happened in the last 24 hours. Yes, the biggest stock in the world fell 3.58%. Nvidia, also one of the hottest stocks, fell 3%. And we saw Tesla fall a little bit more and then rally into the close. So what does that mean for the stock? That and more coming up in today's show. But let's discuss something I shared over on X or Twitter, and you can follow in the links in the description down below. And that's the bullish percent index. I just want to bring it up because we've seen this play out before. And more importantly, we haven't usually seen what we tend to do, which is a capitulation on a bear bust. Whenever we see nice corrections, usually the market will sell off aggressively, freaking everybody out, and then rebound fairly quickly. We certainly got a rebound, but we didn't see the bullish percent index do much more than usually just a little bit of a dead cat bounce. So basically a false rally. Is that true? Is this indicator helping us again? I'll be updating over on X to make sure that we're always on top of this over the next couple of weeks. So make sure to follow us there. Let's also talk about stats. We know we're in the weakest month of the year, and I think that we've covered that quite a few times. I'm pretty sure everybody knows this by now. The question, though, is with the post-Labor Day week, let's say we end closing bearish, will we get a pre-OPEX bullish week? Traditionally, yes, 30 to 20, remember, is the stat towards bulls, but it's the post-OPEX week that I want to think about. What happens then? Well, if we break down most of the post-OPEX weeks, you can see here that Wayne Whaley's gone through and he's broken down over 50 years of data to really tell us what goes on in September. And more importantly, how the September 19th to 26th run is the worst. Have a look at these stats and some of these data points. You can see that generally, if it's going to be a really bad sell-off, it's somewhere in the vicinity of 3 to 4%, and usually not much worse. If that did happen at certain points in the future, it's possible that we could hit a 4,200 or even 4,150 on the market. And I know the bears would certainly be cheering that point. But for the bulls, it's not quite over yet. And you'll see when we go through the charts later on in today's video why that could be. So let's now take a look at why bulls should be maybe a little bit happier with the stats. Of course, when you have a super positive year to date into August, even though August was weak and September may still be weak, remember it's only a 75% stat here, negative 3.5 is possible, then we usually go to a 100% win record. Don't forget, most of the selling for September tends to occur based on 1950 to 2022, so over 70 years of data here, all the way near the end, the post-OPEX or post-quadruple witching event. That tends to be when we see that sell-off. For longer-term investors, you're always looking at certain metrics, and here's one from JP Morgan, which of course is the forward PE. We're sitting around 18.6 at the time of this recording, and we're nowhere near the average, which is still on 16.77. Imagine if we hit 4,200 though. Considering some of the upgrades some stocks have gotten, I'm pretty sure we'll be getting close to that average, and I'm sure a lot of buy the dip buyers would be very excited by a level down here. This is a bit of a chart showing you what's happened over time, but as we get into these 19s and even 21s, you know we're starting to top off usually in terms of where investors find fair value. We have hit bigger ones before though. Back in March of 2000, we hit a 25.2 times forward PE. We will update you on the sentiment. I've already had some guesses coming in from everyone in the community. I guessed that we were going to go towards a 35 to 36% bullish read this week, and the bears would go down to somewhere around 31 to even 29. and most of you have got your guesses in. So we'll see who's winning, but basically we will have this report in our next video, and that will give us a bit of an idea of whether Wall Street has potentially trapped bulls into this recent rally or not. Now, yields is what everyone's discussing. So why do we need to pay attention to yields? Well, of course, liquidity stress index is very important. I'd say this is spiking back up again. We'll get an updated chart on this soon. But more importantly, when we see yield going back above 5%, 5.1%, especially the US 10-year approaching new all-time highs, we've tended to see something break. Will that be the case? Well, it has been in the past, and I always believe that if we get a new high on US 10 years, something is breaking in the system, and I'm sure we're going to find out about it in due course. Let's discuss now dark pool liquidity before we get into the options and the chart discussion. And dark pool liquidity helped us a little bit to try to figure out that this rally so far might have had a dip in it. Basically, we saw a lot of large funds potentially placing short positions on what we call leveraged or slightly weird ETF zones. Now, we've had this a few times before. The only problem is, did they just close their position? There were some shorts the other day that came through on the Qs as well with Ultra Pro shorts, and this is SQQQ, and there's quite a few other positions they've gone through. But we saw a nice here dark pool sweep, number 86, so a fairly large volume coming through. Is this further confirmation of shorts, or are we about to reverse? The price action here is going to be very interesting, because if this was them taking profits, it's possible they do go in short and sharp and look for these kind of quick moves. But if that's them getting ready for another kind of bust down, expect this thing to explode, and of course for us to pressure equivalent on the SQQQs of 1950. That's going to be where they're defending the next zone. The next 24 hours, and in fact the next 2 days of trade, are going to be very interesting for all of us. Another one is everyone's discussing energy, but at the same time that we're discussing energy, we're seeing some large trades at previous XLE peaks. So this is the sector for, of course, energy stocks. I think there's a little bit of profit target taking happening here, but it doesn't mean that energy's run is over, and we'll show you that on the charts a little bit later in terms of spot. Let's now move over to the wonderful world of options, which we always take a look at every day. And it looks like Zoom continues to really represent. We mentioned that in the last 24 hours, and he put another decent day together, 1% with some unusual options activity, 1.29. And I've taken a look at the charts, and I've got to say they look pretty damn good. 18,955 calls. Everyone was stacking puts, but guess what? It went up. Yeah, I think that the charts actually present a lot better, and I'm surprised everybody was trying to go against this stock considering how good it looked. Everyone's still piling into iShares Silver Trust as well. This is not going well for most people. 2.1 times the average 90-day volume. You can see here there's a big battle between the bulls and the bears in terms of volume, but overall the day was pretty close to a standard day. 51% puts though to 49% calls. So the bears were more active in the options market than usual. A lot of the time we're looking for calls to continue getting ramped as the market's coming down to show us that there's more room for further selling. As we know, this week can be very lackluster. Next week tends to be more bullish. So if we're looking for bears to really take control of this market, we're looking for them over the next 48 hours. Then next week, maybe a little bit of a relief rally. And then, of course, post-OPEX week, that'll be very interesting indeed. Now, why are we kind of thinking, oh, maybe there could be some sellers? Well, the first time in a little while, we finally saw some defensives doing okay. Utilities, staples, and healthcare, although they weren't up on the top, they were close to the top. GDX also, gold and financials and energy, so some inflation-based trades as well, were holding firm at the high, with basically regional banking getting smashed the most. This has to do with some liquidity questions that we will be answering in our weekend video. We also know here that energy stocks are starting to do pretty well over 5 days. In fact, they've been doing well for a while. Metals also have been doing well over the last couple of weeks. We've talked about iron ore many times, but it brings us to a 5-day average for semiconductors to actually be down 0.03%. I bet most of you did not know that. Staples here, healthcare, utilities, still absolutely horrid. We're looking for those to really get ramped up if this is going to be a proper sell, and that just has not happened. The rotation just doesn't seem to be there from the street. Let's jump into the charts. Let's take a look now at what everyone's talking about. And first off, it has to be yields. I mean, US 2-year yields Take a look at this one, 5.0%. We've gone back above 5, and you would have thought this was not going to happen. You know, we did not think that 5% was going to be hit again after we started to see it down here. But then, of course, it reversed instantaneously. Now, 5.1 becomes the big limit. When the market goes into the unknown, markets freak out. That brings with it capitulation. If you remember what we talked about at the start of today's video, we talked about the bullish percent index. Usually we do see some kind of capitulation on markets, and we already know that markets don't like the fear of the unknown. So if we hit past 5.1%, that could be a very big trigger for markets and especially sellers. Take a look at this US 10-year as well. So I had set alert, actually this should be at these highs here, and we're looking for a break and close above 4.33. If that happens, again, the fear of the unknown on the US 10-year, it's going to have dramatic ramifications. If you're a gold trader though, you do not want this thing above 4.33%. That's going to be very bad for gold, at least temporarily, although we do remain bullish on the metal in some kind of weird stagflation that we could be going into, or even a rate cut environment in the future once we've done these last couple potentially rate hikes that could be there from the Fed. We don't know yet. Of course, we might think it's just pivoting. We have no idea at this stage. Treasuries. Now, treasuries have tons of issuance. So we've warned against this being the low. I know everyone's talking about it being the low. I don't think it is. I'm not sure, but I certainly haven't seen a trade change of any kind of movement yet. Yes, we got a bit of a relief rally, but we didn't go through 97.50, and that to me means that we haven't put the low in just yet, at least on the charts. So what are we looking for? Well, 88.90 seems still likely for treasuries, and we'll be paying close attention to the charts as we move forward. The VVIX, this is the volatility of the volatility, continues to spike up. A good sign for the bears and obviously a bad sign for the bulls. Basically, if the volatility underlying is starting to spike, it means that people are getting freaked out ahead of, guess what, inflation. So this could be like a sell the rumor by the fact. Inflation numbers are coming next week. I think it's like Tuesday or Wednesday. We'll look at it at the end of the video. And basically, when those numbers come out, we are going to have that volatility spike, and then probably it'll compress straight away. But in terms of people freaking out, that seems to be what's happening here. We went down. Let's have a look at this on a non-line chart for a second. Go candles. We didn't quite get to our 12.12 for the VIX, but yes, the volatility of the volatility is spiking, and that's something we're watching. We also saw a big sell-off here of stocks, or percentage of stocks above the 20-day moving average. Now, this spiked a little bit higher than we wanted it to. Of course, usually when you're getting these kind of fake rallies, they're usually pretty fast and sharp, and they don't usually get above this red line here unless they're real rallies. Now, we did get above this red line in this case, the 20 moving average here, and then we sold off. Now, of course, if we go to a new low, well, we'll already be capitulating at that point, but something to watch here. And also keep an eye on percentage of stocks above the 50-day moving average, because that didn't quite hit what a normal rotation of a sell-off was, which is to move back below kind of into that 20 to 25% of stocks above the 50-day. That's usually where you're starting to see a potential low for markets. Let's now move over to the skew. The skew got crushed again. Good for bears. We've talked about this quite a few times. And then we'll move into metals. So basically, we're looking at the metals. And still, everybody that says that China's going down and everything's terrible and everything like that, well, I say let's look at the copper market and look at the metals markets in general, and particularly iron ore, which is heavily, used, of course, in their economy. It's not falling, guys. This is still a very strong price for iron ore. And if you noticed, when the media got most negative on China, all of a sudden, what did we see? We talked about Vale, we talked about BHP, and we got nice 4, 5, 6% spikes on some of those stocks on the way up. So it just shows you that sometimes the reality of what the price is showing you and what the storylines are telling you is completely different. That's not to say there isn't some severe sickness in that country in terms of the property market. It's bad. We'll see what happens soon. But we do expect something to go on in October. And I think the market's kind of pre-prepping itself for this. Let's move over to the US dollar. It's on its way towards our targets, which is 105.16 to 105 kind of 20 zone. And it almost reached it over the session. But yeah, that was a super strong rejection here. And the US dollar just keeps pushing up and up and up. We've talked about it in previous videos, and we still think it's probably going a bit long. Gold's holding itself, but for gold spot traders, I do have a little bit of a concern. We are going into a weakness period for gold traditionally. And remember, if yields do break out to new highs, it's going to be a problem. So 5.1% and 4.35 on the US 10-year, not going to be good for gold. We'll need to be watching it very closely. For gold stock traders, it held itself. So it actually held exactly where you wanted it to. 28.50 was achieved. We ended up closing at 28.47. So if it's going to be the bulls coming into gold, they're going to have to do it somewhere around here. And hopefully they can do it. And gold stocks are still well underpriced compared to even where spot is at this stage. So it will be interesting to see if we see some rotation into that should the market start to sell off and they go defensive. US oil, I don't know if we can stop it just yet. It looks like it's going on to possibly like a $90 to even $92 a barrel. It's a very strong looking chart at this stage with basically every dip being met by super bull demand. And at this stage, that's the way you've kind of got to look at it. Yes, we saw some profit target taking from, of course, some people in the energy stocks. I wouldn't blame them. It's damn close to their targets, I'm sure. But it doesn't look like there's too much stopping it on the left-hand side until we get into that 90 to 92 a barrel. This will, of course, most likely reach those kind of zones you would think ahead of inflation. Then we get the number. And then, of course, we find out probably it's not as bad as you think. But anyway, that's what's happening here. We're getting a big bunch of oil thanks to, of course, all of the cuts on the barrels. The stock, Apple, let's have a look at the biggest stock in the world, and it sold right where you wanted it to. So I thought it might hold until the earnings, like until the announcement of the new iPhone or something, but it just didn't want to hold. This was the key zone. I didn't think it would get a gap fill, and we all discussed this together, and I think we felt like that was probably the fair call. So we've sold off now. We haven't quite hit 180, which I would usually expect Apple to at least hit 180. And the reason why is that's previous resistance. It's the 20 moving average as well, which we did see some support of on the way up. This was, in fact, one of the most touched moving averages. And then the 180 also will provide that nice psychological 00 as well. I'm not sure if we'll get too much relief off that, but with the stock market hitting a 44.40 as well, or just around it, maybe we get a sell into the next session. We sell, we might find some buyers. If we do end up clipping this though, 176 is the next zone. And if we get underneath that, probably going to a new low. And then at that point, we're going to break through some key S&P 500 points. Let's move to Tesla. Now, this was a little bit better for Tesla bulls than you would think. It was selling, but just nothing could get through this low. It sold. It was down at one point quite a lot of percentage. So let's take a look at that together. It was down 4% at one point. Then it ended up only being down 1.78. People are really bullish on this new Model 3 Highland. They like what they see. And obviously, I think that's helping the biggest traders inside, which is pretty much us, the retail traders, get a little bit bullish on this stock. Still a lot of concerns over this area, which I've already marked here with this big red arrow. I do think there's bears sitting in there for now. If you're a bull, once you get a new high up here, you can be pretty smiley face about what's going on with Tesla. Maybe a new high is in the books, I think. But at this stage, 240 could be where you find buyers just because that is the 20 moving average and previous resistance. I'm not sure. This one's very tough. I would say that there's sellers here and there's buyers somewhere in here. And that's a pretty strong random candle. So it's clearly coiling now for a large move coming forward. Semiconductors didn't move as much as you would think considering Nvidia's sell, but that's how it is. Let's have a look at Nvidia here. 3% down the day. Still very strong overall. And I'm not sure, but I think if you put like a little trend line behind here, yeah, it's still kind of sitting on them depending on how you draw it. So it's still in a fairly bullish run. We haven't got a new low. So mark out something like a 449. If we do get a new low, that's going to be significant. And I think at this stage, while I think that some of these semiconductors are too high, specifically Broadcom, AVGO, which I've talked about a few times on this channel, it doesn't mean that they are the best shorts in the world. You're shorting the best markets. So you have to be pretty damn clear when you're going to do something and you're going to attack some of the best stocks in the market. Semiconductors was the best returner for a long time. Now, one of my most hated stocks of all time as well, which is Zoom. If you've been watching the channel for a while, you would know I really hated this stock back in 2021. And it fell just like I thought it would, is actually making a bit of a comeback. Now, I've discussed this a few times on and off about how I thought that it was building a pretty strong base down here between the 66 kind of base area. But it looks like it wants to do a breakout. And this is against, of course, the current market going negative. thought I'd just chuck it in here. It's a very interesting one. We've obviously got a lot of puts being stacked against it. And if it does break out, could create a little bit of a squeeze. $80 to $84 is certainly quite possible for this stock. It's very risky like any of these hypers, but that's a pretty nice base. Obviously do your own work on it and check it out and see what you think from a technical standpoint. CQQQ continues to hold. This is the Chinese stocks. Nothing much to report on that. It's the same as it was. Still think it's got that kind of that hard base in it at this stage. And the Aussie market is suffering. Look at this. Even with the energy stocks doing well, we're selling, or the Australian market's selling for all Australians out there. Yeah, I am Australian. And it's basically just that all of the market constituents are going down. So we've got quite a lot of sell-off. It's not really in iron ore and energy so much, although there was a div for BHP today, which is a pretty large stock in our market. But it's moving down now to where you would see maybe some possible support. And this is interesting because it's happening and coinciding with some of the other markets. German market, well, it's just in the middle of nowhere land. We've talked about this being a Wyckoff before. I still think it's very possible. We obviously know where the buyers are, which is 15,500-ish, 15,450. And here, I'm not another bullish or bearish, really. If I was holding bear positions, I wouldn't be too worried, though. Let's move over to US 2000. Most traded zone held really well. Made a new lower low. We still have that higher high. Now we can kind of say, okay, well, this could be where buyers come into the US 2000. If the bulls pick up the S&P 500 over the next 24 hours to 48 hours, then maybe this is the low point here for US 2000 before some recovery. But let's put this in perspective of what's been happening in the markets right now. And I want this to go through just so we can kind of look at it. The US 2000 is still so weak. With the recovery that we've seen, it's so unusual to have these small stocks just doing so poorly. It's the high rate environment, the fact that there's so many zombie companies. These are companies that basically can't even earn enough money to pay off their own debts. I think it's something like 10 to 15% of the entire US 2000 is filled with what we call zombies. We have to do a special on that soon. It's pretty concerning. But from a price action standpoint, we're back on a little bit of a demand. And of course, we've got a long leg doji. If we close below, then we're probably moving back down to the supports of 1830. But yeah, at this stage, we're at, I guess, neutral zone in that market. The Qs did sell, but they didn't sell super hard. Let's have a look at the Nasdaq here. Now, interesting, it did take a new low. So it broke underneath 15,322, which we've theorized exposes 15,100 and 15,050. So basically, this is the last demand. There's almost no trade volume in here. So because there's no trade volume, we thought, oh, well, we should be able to move down to this level. We're long with the S&P 500. But here's where it gets really annoying for Nasdaq shorters, is the S&P 500 kind of did it. It already did it. It filled all of that really weak kind of volume trade, and it did in the last 24 hours. Now, we saw a recovery off this area here, which just so happens to be the 20 moving average on the daily. And if we go back to history and we go and have a look at the S&P 500, we know that this is being pivotal. So for bulls, they got to hold it here. And I'm looking for nice, small, short-term structure to actually show that bulls want to hold it. If this is the dip that we're going to get before, making a new high. If the bulls can't hold the 20 though, ooh, that's going to be worrying, I think. Look at these 20 touches. Look how well the S&P 500 has respected these 20 touches. It broke through. It should be testing here. That's fine. Totally expected. This is where you expect buyers to come back in. So let's take a look at the structure that it's creating right now. We've got a low. We've got like a little bit of a recovery. Let's go smaller time frame. I know a lot of you like going to the smaller time frames. So there is a case to be said that we might flush in the morning and that we've already seen a little bit of a recovery here on the S&P. You can see there's quite a lot of trade through this zone, and this zone, obviously a good target would be 44.90 for a day trade. So if it comes back down to something like a 44.55-ish kind of zone, I think somewhere around there, we might actually find a buyer, and they may push it and try to get back to 44.90. This is a fairly bullish market. If you're a bear, though, you just want to see a new low. New low, daily close on the low, ooh, would be bad for the markets. So, of course, you want a daily close low, and more importantly, no wick. See this wick here? It shows us there was a buyer somewhere at the end of the day. And that's the problem when we couple that up with maybe those like little quick sell-offs in some of those big SQQQ funds and other things that we're seeing at the moment. maybe they did just take some profit off their little quick short. But yeah, critical level, a lot of great structure to be looking at over the next 24 hours. Bitcoin, totally boring. We won't even go into it too much at this stage. Still looking, it's coiling, it's doing nothing. If it does break to a new low, remember, it's a very thin market, so it could sell incredibly quickly. 22,000 is the next stop, and then 20,000 underneath that. If you're looking for buys, I'd still like it to take a low, instantly reject, and then get back above where that Bitcoin ETF was. And that probably marks the low and possibly a really nice beginning of a great rally for Bitcoin. September is the worst month, though, for Bitcoin traders, so watch out. So it's Wednesday, September 13th for the CPI. I do think markets could remain very scared coming into this number now. Why? Frankly, just the US oil and obviously what we're seeing with yields. This number will matter like it always does. It's funny how the market's set up for it. So make sure to stick around on this channel and, of course, get into the comments down below if you're interested. Also, check out our links down below if you're interested in attending our September FX Evolution conference over in Las Vegas. It's going to be an amazing event. We've got ex-Goldman Sachs options traders. We've got CMT traders. We've got people that are specialists in directly very, very good indicators such as VWAP and a few others, anchored VWAP as well. So some of these are amazing indicators. I'll be taking notes as well. And of course, yes, I will be speaking along with everybody else. If you're interested in meeting us and interested in attending and getting into some great discussions with some of the community members, I've met some amazing people that watch these videos and obviously are part of this team, then check it out in the links. Thanks so much, guys. Subscribe, smash that like button. We'll see you in the next one. Bye for now.